Most of the homeowners believe that the tax benefit on the home loans needs to be from a bank. As a chartered accountant, I often see many of my clients missing out on this massive opportunity. Today, let's unlock the full potential of Section 24 Clause B of the Income Tax Act and check whether the lender needs to be necessarily a bank or can it be anyone else. Section 24 Clause B of the Income Tax Act clearly states interest on the borrowed capital shall be allowed as deduction. The key word here is borrowed. The law is broad in this sense. The law doesn't restrict you that you have to take the loan from the institutional lenders. Whether you take the loan for the purchase of construction or repair or even purchase, the cost of the capital shall be allowed as deduction under Section 24 Clause B of the Income Tax Act. So this means if you have borrowed any kind of money from your friends or relatives to fund your dream home, the interest on the borrowed capital shall be allowed as deduction under Section 24 Clause B of the Income Tax Act 1961. So, having said all this, what is the benefit in monetary terms? 2 lakh rupees is the limit of deduction. If it's a self-occupied property, you get 2 lakh rupees worth of deduction. If you have let out the property, there is no limit on the interest on the borrowed capital as deduction, but there is a caveat. The under the income from house property chapter, the limit of deduction is capped at 2 lakh rupees. So you'll be getting 2 lakh rupees worth of benefit or deduction. A quick comparative analysis between the borrowings that you have taken from the bank and from the relative. Now, the interest component in the Section 24 Clause B, as we have seen and discussed earlier, is eligible under both bank loan as well as loan from relative. But the principal component under Section 80C is eligible only when you take the loan from the bank and not from the relative. But let's come to this point a little bit later. Documentation purpose, you need to have a bank statement and interest certificate from loan from relative. TDS compliances is generally exempt in bank loan, and TDS compliances might be required when you take a loan from the relative. Now, the most important point is let's come to the principal component. Now, when we say the loan from relative, the principal component is not eligible. Now, let's imagine you have already exhausted the ATC benefits and that you have. You might have been, claiming deduction under ATC, from Sukanya Samriddhi scheme or LIC or any other, ELSS, equity linked savings scheme, etc. In such kind of scenarios, loan from relative can still be beneficial. You do not, since you've already exhausted the ATC benefit, you can still claim 24B and be in a beneficial situation. We spoke a lot about the hidden gem under Section 24 Clause B of the Income Tax Act 1961 about interest on borrowed capital, even if the borrowed capital is from the relative. But it is very important for us to be within the purview of law. So you need to comply with the eligibility checklist. You need to comply with the documentation and various TDS compliances. I'll just quickly go through with the eligibility checklist. You need to be the claimant must be a legal owner or co-owner, project completion within 5 years for full benefits, and sign confirmation of interest paid from the relative. The loan must be strictly for property related expenses. I've also given a projected tax impact and what benefit you would be getting. If you want this PPT presentation, give me your email ID. I'll just send it to you. And with respect to administrative rigor, you need to have an interest certificate. You need to track your bank payments. Payments should be made via verifiable banking channels to avoid scrutiny. And you need to obviously ensure TDS compliances if eligible. So this was a small video about Section 24 Clause B of Income Tax Act. Please consult your financial expert for better clarity and better financial planning. Thank you.